From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, March 19th. You're listening to the Macrocast. This is Tony Fratto. We have John Fagan and Brendan Walsh from Markets Policy Partners with us. John Dick from Civic Science with us. And great to have you back, John. We had a really good economic sentiment index this past week, showing that people are pretty pleased with the outlook, and definitely want to get into that because it has such a huge macroeconomic impact. If people are feeling good and positive and optimistic about the future in all the ways, they're going to become economic actors. They're going to go out and do stuff. They're going to spend money. And we're going to start seeing evidence of it in the economy. Tell us what the ESI showed us.
Well, I mean, it's pretty rosy. Highest number we've seen since weeks before the pandemic even was a thing. So we're going back into late February or mid-February of last year before we saw numbers as positive. So we've rebounded and then some from a consumer confidence standpoint. Optimism for the long-term outlook of the U.S. economy is particularly rosy, which is generally a strong sign and a strong leading indicator in our data for the things you mentioned, which is a lot of spending. We saw even a week before, so the ESI came out, I think, on Tuesday or Wednesday. We saw last Friday, we've been tracking something fairly closely since last summer, which is a question in our database around whether people consider themselves to be better off or worse off financially than they were before the pandemic, which seems like something of an insensitive question if you think about it because of so much of the job loss and other things that have happened. But last week, for the first time, a larger share of Americans said they are, quote, better off financially than they were before the pandemic, larger than the group who said they were worse off. And there had been a pretty large gap as recently as even October and November between the worse off crew. What that means is another simple way to put that is that the average American is better off financially than they were before the pandemic started, which is crazy to think about it. Yeah. And if you'd told me that was going to happen before the pandemic was gone last year, I would have said you were crazy. But that's where we were. And that felt like a harbinger of what was going to be a really positive economic sentiment index, which is what we saw this week.
Yeah, I mean, I guess that the tale is, at the end of the day, is part of it is this story and the shift in the economy that large parts of the economy actually have been doing very well because people just changed their spending habits. The other is you throw a few $1 trillion, pour that on top of the economy. A lot of people are going to be doing okay, and so that's, I assume that's what we're seeing. We're all
better off, worse off question, Tony, preceded the stimulus bill passing, right? So now, look, if you are in need of a stimulus check, chances are that stimulus check is not going to crest you over the top of like, oh, now I'm better off financially than that, right? You're probably still in that lower group, but it's $1,400 plus whatever dollars in new spending that group of people will have. And we can talk a little bit if you're interested on sort of where we think there's also tax refunds starting to show up soon. And so there's going to be more money that's going to be going into the economy that people didn't have 60 days ago. But yeah, there's the gasoline has not even fully been poured on the fire. The ESI was going up before the stimulus bill passed. So I think is as high as it was this week.
Well, we should say the second stimulus bill, though.
Well, right. Sorry, correct.
We did have a big stimulus. We had $1 trillion stimulus in December as well.
Right. Well, fair enough. Yeah. But I think I don't see any reason that the next one's not going to be even higher than this one, right? 2 weeks from now, meaning the economic sentiment index in 2 weeks. I mean, the momentum, we track it on a daily basis. We report it on a biweekly basis, but we're tracking it daily. If you look at the 3-day rolling average up until the time we released it, there was velocity. It was accelerating, which means, we should be seeing numbers 2 weeks from now, unless something unforeseen happens, that are even better.
John, you've mentioned in the past the disparity between perceptions between Republicans and Democrats, depending on who's in the White House and what administration there is, and the flip that occurs. And you did see it before Are you seeing something similar now? Is there a disparity along political lines with respondents on the Republican side being more downbeat, given their political leanings?
I mean, we're definitely seeing people center and center left more optimistic, but it's not sort of equivalent to a downtrodden view on the right. I mean, even the right is up there, just not up as much as the left, right? Whereas what we saw in 2016 and 17 after Trump was elected, we saw the lines go in opposite directions. Republicans got supremely confident about the economy and Democrats got non. Both groups are increasing confidence, but the left side of the aisle is increasing much faster. There are other sort of, you peel the onion back a little bit, where we're seeing kind of the political tribal thing play itself out right now is in sort of the return to normalcy, return to spend figures that we look at, particularly as it relates to vaccine proliferation. We would think getting vaccinated would be a leading indicator of someone who says, yes, I'm willing to step back into restaurants and step back into public places. But it's not really playing out exactly that way, because what's happening is the group that's getting vaccinated first, which is the most at-risk group, is still a pretty cautious group. They're not saying, hey, I'm going to go to a concert tomorrow in a Penguins game, right? They're still saying, look, I'm protecting myself, but I'm not going to re-enter normalcy until the balance of the country has done so. What's ironic is that the group that's saying, yeah, I'm ready to go back to a restaurant right now, and yeah, sign me up for the Penguins game, is the group that says, I'm not planning to get a vaccine. It's the political right group, right? And I don't mean to be overly stereotyping here, but sometimes it's a time saver. They're the group who's least cautious about COVID, and therefore more sort of cavalier about returning to normal consumption, is also the group that says, I'm not going to get a vaccine anyway, which just makes the numbers kind of weird,
Yeah, it's completely weird, and
that's right.
But I guess, but very rational, and I guess you would expect it. There's also probably like one other rational observation, which is, you go back pre-COVID, a year and a few months ago, and so the economy was, really good, really low, decent growth, low unemployment, wages increasing, and you probably had some people who felt like, if you ask them, do you expect your personal financial condition to be better a year from now? You might say like, well, maybe better, but I don't know, it could be much better. It's pretty great, and you probably had other people who, if you were not doing well in that economy, in January of 2020, you're probably pessimistic about that outlook, and that wasn't going to change. I think pretty much everybody can have a view, right? It's actually, in a way, not surprising that if you just imagine that vaccines are coming, reopening is going to be coming, economic support is there. People ought to be optimistic, right? I mean, like, we're off a lower base, and so like, can only go, for a lot of people, like, can only go up from here, because I will actually be able to go work at my job at the restaurant, or those kinds of things. And if you have been doing well during this period of time, you can imagine it getting better.
Yeah, that's a really good point.
Yeah.
Economically, you might have crushed it because the stock market's up or whatever, and you don't spend anything, but you're really sad. You want to go see your friends.
Yeah, you're going to get to travel. You're going to get to go do.
Well, and even the weather matters, right? I mean, like, it's warming up, and I can go outside and play golf again, and eat at a restaurant on the sidewalk. Like, February. Part of what we're also seeing is a little bit of a rebound, because February was kind of like relatively bleak just because the weather was so terrible, right? I mean, it affected.
In southern Florida, it was beautiful.
The storm was had a pretty big impact.
Yeah, in southern Florida. Yeah, I'm sure Florida's.
All you fools that stayed in the Northeast.
Right.
Well, Texas had a rough.
Good for the carrots.
But I think one of the biggest, indicators we've seen in our data is sort of intent that consumers are expressing to spend or save. Well, interestingly, people are about 30% of people who say they were going to receive a stimulus check plan to save it. About About 37% say they're going to pay down bills. That's pretty consistent with what we saw in the last wave of stimulus.
The rest are piling back into GameStop with it.
Yeah.
Well, Bank of America estimates about 30% will find its way into the stock market.
That feels about right. So if we have save or invest, and if we assume saving sort of means it finds its way in the stock market one way or another, it's actually the same. But here's the interesting thing. 30% of people who are saying they're planning to receive a tax refund plan to save it, which is the same rate as the stimulus bill, but that's down from 40% last year. So 40% of people last year said they were going to save their tax refund. This year, it's only 30%, which means we're going to see a lot more of tax refund dollars going into the economy by way of spending. More consumers are saying, no, I'm going to buy stuff with my tax refund check. Electronics, actually one that was kind of surprised me is we're going to see a surge in apparel spending. Right? People are going to buy clothes again because they're going to leave the house again. They might be starting back to work. We're going to see a nice surge in soft line apparel spending in the next 4 to 6 months.
Dudes will be fresh pairs of, cargo shorts and, right?
And that feeds into the discussion about back to school. Obviously, for people like myself with kids, getting them back to school is a huge watershed event. It'll change the way that the rhythm of our lives in like even more profoundly than getting a vaccine ourselves, I think. Are you seeing that? Are you picking that up, John? And in some, I know you mentioned youth sports apparel as part of the big boost here, but is there going to be a big back to school push as schools reopen in greater numbers?
Yeah, I mean, hold on to your hats for back to school. It's going to be nuts, right? Because you got an entire year of, the kids didn't get clothes and most of them grew, right? So they're going to be fully newly outfitted. What's that, Tony?
It's a great point. It's like, it's not like they stayed the same size,
right?
It's not like they could wear the weekend.
Incidentally, a lot of adults didn't stay the same size either.
Most directions were resting, waiting for the opportunity to come back out again, but not for kids.
Sweatshirts stretch, so but yeah, John Fagan, you mentioned the one category I would bet the farm on right now is youth sports equipment for the summer, because travel ball is going to come back and all those kinds of things. And that's going to be good for hotels and all of that. We're going to see a nice surge of that. It's hard to decouple return to school from return to work, though, because a lot of people, you mentioned sort of it's more important than the vaccine. In some ways it is, because I could be vaccinated and fully ready to go. But if my kid doesn't have somewhere to be from 9 to 5 every day, I can't go back to work. So those things are going to be really closely associated with it. And I don't know if we want to, it's a whole nother kind of rabbit hole to go down, or maybe we can talk about it in the next segment, is return to work is something I'm paying particularly close attention to, because not so much in the short term. We know that's going to unfold as vaccines unfold and companies open up again. Longer term macro picture of as remote work becomes more standardized, we are seeing some remarkable metrics on our data around intent among people who say, you know what, if I can start working remotely, I'm going to move. Like not move from my house to another house, but I will leave the city or state. About a third of Americans say if given the opportunity to work from anywhere that they could choose to work, would not work where they currently work. Right. So they are tethered to whatever city or state that they're in, primarily because their job keeps them there. They would much rather do that job from somewhere else. Now, those numbers are lower among parents because you don't want to uproot your kids or whatever. But in a world where we're competing for young talent, and young talent with no kids wants to work anywhere they want, what's that going to do to the workforce and real estate? And it's just really, really fascinating experiment. It may realize, Tony, I'm sure you remember the name Richard Florida from your time in Pittsburgh. It may realize the vision he talked about 20 years ago of this sort of creative class dynamic and how workers move around. So anyway, maybe different topic for another day, but it's something we're paying super close.
No, it is a super important topic. And maybe if, and in fact, I'd even love to do just a separate Macrocast just on this question, John, when you have, maybe if you pull together some sentiment on some of these specific questions.
Sure.
And we can pull it together, because I don't think of it as a scary thing, by the way. Like people, I mean, like I'm sitting here in New York City, and there are people who worry about New York City. I don't worry about New York City. I think New York City is going to do great, and I think it's going to be fantastic. And some people are definitely going to leave. Other people are going to come in.
Yep.
It's sort of like a reshuffling of taste. The idea that everybody has just been like shackled to the city and just waiting to go out like green acres to the country is just bonkers, right? People have different tastes and different desires and different needs. And, I'm more of was it Ava Gabor or Zsa Zsa Gabor? Which one was it? Was it Ava or the Green Acres? I can't remember.
I think it was Zsa Zsa.
Oh, that was Zsa Zsa.
It was Zsa Zsa.
Yeah.
I'm more Zsa Zsa. I mean, I get both. I get Zsa Zsa Gabor here and in New York City, and I get to go out to the mountains to our house. But like people will sort and resort. Some people love cities. There are people who would love to live in New York City, but couldn't live in New York City because they're tied to their job or for whatever reason, or they think it's unaffordable. And now all of a sudden, it's affordable. Would love to go live in a city. So I'm not scared about it, but definitely there are economic implications for it.
The list of LinkedIn, I think, put a list up of the cities that have gotten the most increased, the net increase of population. It's pretty eclectic. Salt Lake City was on the top of it. You can quibble with the methodologies of it, but Salt Lake
had been going for years too. Salt Lake City had been crushing it for the last 7 years.
My sister,
Goldman Sachs, that was the biggest city for internal transfers for Goldman Sachs. Is they have their back office in Salt Lake City.
Yeah, there was Jacksonville was number 2, but then there were some cities in Cleveland, cities in Ohio were on the list. It was very interesting. There were some Midwest, and I think that's possibly driven by there are a whole variety of reasons why people would want to live someplace outside of the major metropolitan center, and affordability is certainly one of them. We've seen that dynamic of house prices go up and up. That the supply response hopefully will kick in here. That would be great for the economy and good for everybody involved. But I think that brings to mind a question that is, if you're looking for a negative on all of the optimism, and certainly people on Wall Street have been focused on this kind of negative, is that overheating inflationary aspect. Do you have, John, in your various metrics and surveys, do you have an inflation and price pressure concern showing up anywhere? That's certainly what Wall Street's most focused on here.
We don't, because it's a hard thing to ask the consumer about, right? That's really what our data is sort of the consumer's expression of these things. And consumers don't see inflation coming before it hits them. They may see gas prices are up a little bit, but we're driving less. And so it's not hitting them as hard. And, they anticipate or fear things like last summer and through the fall when we would maybe even longer than that ago, we were asking about the impact of tariff costs hitting households. Right. And more of it was perceived than I think was real. It was just the idea that these tariffs were going to hit my personal, my checking account. And there was a political dynamic to that as well. But no, we're not a good we're not a good tip of the spear when it comes to seeing things like inflation come. But it's something that worries me when I see this much exuberance about spending among consumers, that's something that we'll have to guard against.
We haven't seen inflation for so long that, it'd be like asking them about ghosts, right?
Yeah, right.
But the ghosts that they do believe in, right, is they see things like so you mentioned gas prices. Like if you went back and asked consumers about prices back in 2007 and 2008, when gas prices were doubling on themselves and spiking, and we actually were seeing price increases in food and gasoline. They thought there's inflation. In fact, you'd have these conversations with people. It's actually core inflation and average prices are actually all pretty low, and other prices have come down. And they're like, no, I don't know what you're talking about. Prices are through the roof, but real inflation was actually actual inflation measured was relatively low.
That's the other thing consumers.
Go ahead, John.
No, go ahead, Brendan.
But when you talk to supply chain experts, where now we are having shortages, but they are, rather than raise prices because you don't have your inputs, what they do is delay delivery, because they don't want to be a penny wise pound foolish in the short term and anger a client by raising prices. So instead of getting it in a month, you get it in 2 months.
Yeah, that's particularly a consumer issue. And this is where I think also the other hard thing about asking a consumer is they don't understand what actual inflation means compared to, I paid more for something, right? Which, like, for example, lumber prices right now, we're getting some repairs done to the deck in our new house. And I had done the same thing at my old house a year ago or maybe 2 years ago. And the lumber's like 5 times more expensive for like a single 2x4. That's not inflation per se. That's a supply chain problem when it comes, like, I'm willing to overpay for lumber right now because I need my deck to be done before the summer, and everybody's saying as home improvement is like going to explode even more this year, we're going to see those kinds of things increase in price. That's not true inflation in the sense that, like, to the consumer, they think that's inflation and it's not, right? It's a supply and demand problem.
I agree.
And that's really been the point that Chair Powell has tried to hammer home. He said it in his statements yesterday, on Wednesday, following the Federal Reserve decision. And it really was, this transitory aspect. Supply chains are going to be rebuilt, and we're going to get to the other side of it in a really meaningful way. So that's I think that's a narrative that resonates.
Hey, John, I wanted to go to that, and but why don't we take a break and come back? So I'd love to explore a little bit of that, of what Chairman Powell said this week, and some else of what he said at his pressure with the FOMC meeting the other day, and so let's take a break here and come back on the Macrocast and dive into Chairman Powell's presser.
Every 2 weeks, HPS measures U.S. adults' feelings and expectations for the economy. The Civic Science Economic Sentiment Index, powered by HPS, accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us through hamiltonplacestrategies.com.
All right, we're back on the Macrocast. John, you started talking about point that Chairman Powell was making about about supply chains and bottlenecks and possibly leading to transitory inflation. His presser this week got a lot of attention. I'm not sure that he didn't say anything much different, though, did he?
Not much different. He really stuck to the script, and that was expected. But there were some atmospherics and other communications aspects around what he was going to be saying. His verbiage pretty consistent, and as we said, his characterization of inflation as transitory and so forth. But at the same time, there's just there are all the Federal Reserve economic projections that are accompanying. So it's not just you're seeing it in the numbers that are coming out along with his discussion. There was also the dot plot, which is the projections of the individual members of the committee about where they think rate hikes are going to be timed over the coming years. And coming into this meeting, there was a lot of attention. There was a lot of focus on how the Fed would balance this brightening economic outlook and upgrade their forecasts that were almost certainly going to be coming through. And on the other hand, holding this doggedly dovish policy outlook. And so there was really, it's hard to say that he could have done a better job than he did. And focusing on the transitory aspects, saying that these are projections that we're looking at, and our policies are outcome based. We've got to, we've said that, the Fed is Missouri right now. They're the show me state. You got to show me the growth. It's one thing to draw a dotted line on your model that says it's going to be terrific, but it's quite another to actually get there. And the Fed is absolutely focused on getting there and also calibrating its policy to bring the most damaged parts of the economy along with it, which we've said the markets took this in a kind of a mixed way. There was, on the day, as we've seen, when Powell is actually at the microphone, markets are very well behaved. Yeah. But as soon as he leaves the podium, the markets the Treasury markets start to go off on their own and start selling off and taking their own view. There's an aspect of price action right now which is kind of in defiance of the Fed. The Fed, although on the margin, some more projections of a 2023 rate hike, the first rate hike showing up in 2023 on the margin, those increased. The median is still 2024. But if you look at futures markets, they've hauled the first rate hike into the first quarter of 2023. That is, that's basically market participants saying the Fed is going to catch up with where we are. When you have this kind of strength in the recovery, there's no way the Fed is going to be able to hold 2024 in the face of it. But, right now we're kind of at this pivot point. If futures start dragging rate hikes into 2022, that starts getting into, a potential credibility problem. If you're looking at inflation break-evens, the market-based gauges of inflation expectations, those are kind of in the mid 2% range. If you're looking at the 5-year and the 10-year, those are also kind of at acceptable levels for the Fed. But if you get well above 2.5%, 2.7, 2.83% for any of those, that is a problem for the Fed. We're not there yet, and we've got to watch these levels. But, we saw some turbulence yesterday reemerge after the Fed, a little bit more stability today. And we're hoping that, the markets, and obviously the Fed is hoping that Treasury markets find their own equilibrium pretty naturally.
Yeah, and I don't want to get into supplementary leverage ratio news, but the Fed made some news on that this morning of that it'll be allowed to expire, and we'll save it for a banking show when we talk about SLRs. But that spiked the 10-year and then came back down pretty close to pre-announcement. I think that's where it was, but. I think you're right. I mean, the chairman went through great pains to say, dot plots, what are they good for? Just a bunch of guys just throwing darts at a board about, it's not really, it's not a Fed projection. This is not a consensus, and we only do things by consensus. These are a bunch of guys who are just kind of asked, what do they think about this is going to happen in the future, and to be fair, the composition of the FOMC changes.
Everyone doesn't vote. It's only a group each time.
So anyway, but that was his point, right? It's just look, I mean, you may have different views about when data may show up to that will put us in a position to make a policy rate move. But that doesn't change the fact that we are all in agreement that we will not be making those moves until we see it, and at a moderate level above 2% for some period of time, and projecting it to be above 2% for some period of time. So that's the only projection that he is willing to consider in their outlook is, have we all agreed that inflation is projected to remain above 2% for a long period of time? Then we will, take a step. But we need to see it and project it, and then we can do it.
Yeah, I thought he made two really good points because he said, last March, April, May, inflation went to zero. So the base effects are going to be up on a year-over-year basis coming forward the next couple of months. He's like,
that's a great point.
That's a methodological quirk. I'm not freaking out about this one. So just be clear, if it's above 2%, that has nothing to do with what I think is going in future. And he also said you can only go out to dinner once a night, which I think is a really
I challenge that. I think I've been known to go out to dinner at least twice a night sometimes. In fact, I may do it. But just to
prove them wrong.
Just to prove them wrong.
I know a lot of lobbyists that used to go out to dinner 7 times a night.
Right. National Restaurant Association took issue with the chairman's assertion.
Yeah, well, I think pandemic eating habits have blurred the distinction in a lot of cases I mean, what is breakfast? What is lunch? And what is dinner? We've encountered a lot of uncertainties here.
Exactly. No, it was great. It was great. He also talked about supply chain issues. John was talking about, and there have been like some sort of big anomalies in recent months. But housing prices have continued to climb. Home sales and auto sales have been relatively flat for the past couple of months, and and some of that could be the semiconductor chip issues with auto. So supply is down. Home supply is hard to increase to meet demand.
Yeah, especially single family. Yeah, there's a little bit of a lot of multifamily, but people want single family, and you just can't produce it quick enough.
Yeah. Especially with weather issues. And then we have the weather issues as well. So it'll be interesting. Do you guys have views on, John, ESI should tell us if people are really optimistic about their financial future, that usually translates into big ticket item sales like autos and homes. But is that what you guys would expect?
Yeah, but it's a little different because where we're seeing it, it is, but it's where that money is being spent. Like, the average expected home improvement, home renovation project this year by price is the highest we've ever seen it. So not only are a larger number of people planning to do things, they're planning to do larger ticket things. $15,000 and up sort of renovation projects are at a peak we've not seen them before. Auto's a weird one because what generally drives people to buy a new car is the mileage on their old car. And we basically just put pause on a lot of the mileage on our cars for the last year. So that might just be a delay because people aren't feeling like they need to buy a new car right now because, normally they're putting 12, 15,000 miles a year on their car. And last year they put half that. So maybe there's just a lag. I don't know. We'll have to see. I don't know the auto category as well, but people are upgrading electronics, like buying bigger, more expensive televisions, still buying Pelotons and those kinds of things. So we're seeing, a definite push toward big ticket spending. We just think it's going to slightly different places than it might have before the pandemic because our values and, the things we valued have changed.
So actually 2020 saw a massive increase in sales of used cars because people couldn't take public transportation. So people bought used cars. So there actually was a shortage of used cars. But in the last couple reports we've seen, especially the inflation reports, used cars prices have come off a lot where it's kind of normalized again. And people are looking, if you're going to buy something, now you're going to buy a new car. But every new car has basically on average, 180 semiconductors in it. So they are having a hard time producing cars because cars are computers now. They're not cars.
Yeah, and by the way, I won't be surprised if we see John's point and observation about things like back to school and back to work. You are going to see a surge that is going to result in probably some temporary price spikes in some things and probably some disruptions in supply chains because most supply chains aren't built for surges. They're built for predictable kinds of delivery of items and goods. And I would think it's a challenge for a Walmart, for example, to think about how to stock their stores and try to predict those kinds of things. And
there's nothing our clients ask us more about right now than what they would call demand planning. Almost every company in America felt the pains of nonlinear growth or nonlinear decline, right? They're generally braced for things to sort of climb up into the right or down to the right at a relatively predictable pace. And that just didn't, and they still don't know, what are we going to spend money on first coming out of the pandemic and how fast? And then when will that crest and fall back down on the other side? How do you plan inventory for that? It's a really complex, really unprecedented question that they're trying to answer.
Well, we'll be here to try to answer it as we go. Hey guys, let's take a last break and then do a look ahead to next week. You're listening to the Macrocast.
Economics has a diversity problem. The Sadie Collective is the first and only organization dedicated to addressing the pipeline and pathway problems for Black women in economics, finance, data science, and public policy. Named after the first African American to earn a PhD in economics, the Sadie Collective seeks to support and inspire the next generation of Black women in these career fields. To learn more about the collective and how you can get involved, email sadiecollective@hamiltonps.com or visit sadiecollective.org.
Okay, and we're back on the Macrocast. Brendan, what are we looking at next week?
So on Sunday, the People's Bank of China kicks off with their loan prime rate. They've been holding steady. The Chinese economy is doing pretty well. Then we get the global PMI surveys from market. And then finally, in the U.S., the big one will be the personal income and spending. And within that one, we get the PCE price index, which is the Fed's preferred measure.
It's funny when you look at the China numbers, how close they actually track. I mean, like the sort of like Keisha manufacturing, index, how much it tracks where we are.
Yeah, it's basically a delay of what, a month or so, John?
It's something like that. Yeah. Guys, awesome to see you all. Have a fantastic weekend. John, Dick, as always, thanks for your insights and observations. We'll see you all next week on the Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.